Warren Buffett's investment strategy extends beyond mere dividend income. He actively seeks out companies capable of consistently paying and increasing dividends over time. Constructing a monster dividend portfolio is an excellent way to emulate his success. In this video, we will walk through the steps on how to build a monster dividend portfolio, highlight common pitfalls to avoid, and build a portfolio that makes you $2,332 per month. Given the current uncertain economic landscape, cultivating a monster dividend portfolio is essential for preparing for future challenges. When you invest in a company by purchasing its stocks, you become a shareholder, so you are entitled to the company's profits through receiving dividends. Usually, these dividends are calculated as a percentage of the stock price. This helps investors to see how much they are expected to earn. Companies are paying dividends on a monthly or quarterly basis. Occasionally, companies may distribute special dividends if they are making extra profit. Let's see an example of how a dividend works. Imagine you purchase 100 shares of McDonald's and it pays $1.67 per share every 3 months. Then you will receive $167 every quarter or $668 after a year. Now you can either take out that $668 as cash or use this amount to buy more shares. If you choose to buy more shares, then your investment would be bigger. The very next time when McDonald's distributes a dividend, your dividend gets bigger. Usually, investors would like to include dividend stocks in their investment portfolio. Here is why. While the stock market can experience significant fluctuations, with highs reaching up to 40% to 50% in good years and corresponding drops during downturns, the volatility creates stress to investors and discourages people from investing. Here is an interesting fact. Coca-Cola has increased its dividend payouts for 61 years in a row despite numerous recessions and wars during this time. In a year when the market doesn't perform very well, your dividend payment still comes in and gets more than the previous year. This is what we would like to see as investors. When the bear market comes, you do not need to stress about losing dividends. This is the beauty of dividend investing. You are essentially owning a money-making machine that continuously pays you through tough times. That sounds pretty good, right? Now you see the reason why we need to invest in dividend stocks. But how do we do it? First, play safe. The goal is to receive passive income by selecting individual stocks. A good track record of dividend payment is preferred. If the company is able to increase the dividend payout for about 4% per year, then it is a plus. Why do we need 4%? Because the inflation is about 4% every year. We need to catch up with the inflation. What we don't want is for the stock to pay a big dividend one year and decrease the payment in the following year. This is something that we can easily avoid. Then, conduct thorough research and buy stocks when the price is right. Investing in dividend stocks is more than just a stock price and a dividend yield. When in doubt, take your time and seek advice from various sources. Make sure to be open to different opinions. The ideal dividend yield ranging from 4% to 7%. Be cautious when the dividend yield is too high. One of the best dividend stocks is Texas Instruments, ticker symbol TXN. This is a company that designs, manufactures, and sells semiconductor products. Back in 2014, the stock price was about $45 per share. Today, it is $170 per share. The share price in the last 10 years has grown almost 4 times, or 278%. Same for the dividends. The company has increased its dividends for 18 consecutive years, and each year the dividend growth is at 15.92% on average. The current dividend yield is 3.07%, which is really good for a tech company. Another great dividend stock is Visa, ticker symbol V. As the largest credit card company, Visa cards are circulating all around the world. Every time there is a transaction between customer and merchant on a Visa card, Visa takes a cut from the transaction. The current dividend yield is at 0.74%. That is not an attractive yield compared to other dividend stocks. In fact, Visa has consistently increased its dividends for 15 years. In the past 10 years, Visa's dividend growth rate is at 18.18% per year. Despite its lower dividend yield, the company has been increasing its dividend consistently. This is favorable to long-term investors. Getting paid a dividend is good, but receiving a dividend increase every year is a plus. Inflation cannot stop its pace, so we would want to see dividend growth to beat the inflation. Don't be fooled by dividend yield. Make sure to see the full picture of a company. Past performance is no guarantee of future results, but it shows the potential of a company's commitment to continuously reward the stockholders. Similarly, we have Lockheed Martin, ticker symbol LMT. This is the leader in the defense industry, innovative weapon systems, and showcasing cutting-edge defense technology for modern warfare and national security. The current yield is 2.91%, which is reasonable. Also, the company has a dividend growth rate of 9.51% per year. Most importantly, it has 21 consecutive years of dividend growth. As we can see, the defense budget is increasing every year. Defense companies like Lockheed Martin will be awarded more contracts in the future. Here are some other great dividend stock candidates for our monster portfolio. Caterpillar, with a current dividend yield of 1.46% and a 10-year dividend growth rate of 8.2%. This company has increased its dividend in the past 30 consecutive years. Ecolab, with a current dividend yield of only 1%, but the 10-year dividend growth rate is 8.1% per year. The company has increased its dividend for 31 consecutive years. For the monster dividend portfolio, we need to look for companies that have years of dividend growth. Ideally, double-digit growth from year to year. This would give us peace of mind. When a company can raise dividends through tough times like financial crises and conflicts, it is a good sign that the company is resilient and shows the commitment to continuously paying dividends. Other than the stocks we listed here, there are numerous promising stocks on the S&P 500 list as well. Look at dividend aristocrats or dividend kings. They have 25 to 50 years of dividend increases. Their enduring performance reflects their ability to thrive alongside the economy's fluctuations, making them reliable choices by time. Here are 2 common pitfalls that you would want to avoid before investing in dividend stocks. 1. High payout ratio. This shows what percentage of a company shares its profits with investors as dividends. An ideal payout ratio is between 30% and 50%. A payout ratio below 50% would give a company enough cash to cover costs and further development, especially for industrials. Payout ratio between 50% and 70% is acceptable. A payout ratio above 70% is not ideal because the company distributes way too much profit to the stockholders. Then it leaves no funds for development. A good example is AbbVie, a pharmaceutical company dedicated to discovering and delivering innovative medicines and solutions for complex health issues. Back in 2014, the company paid $0.4 per share per quarter as dividend. In 2024, it pays $1.55 per share per quarter. So, the dividend growth rate is 14.11% per year in the past 10 years. In 2022, the company spent $6.5 billion in research and development. This number has increased to $7.6 billion in the following year. The payout ratio is 53%. Even though it is a little bit high, it still leaves room for the company to grow. So we can see AbbVie balances its dividend distribution and company development very well. 2. Focus too much on the dividend yield. Many dividend investors are looking for high dividend yield stocks. This sounds attractive at first, but it can be deceptive and unsustainable in the long run. This situation is commonly referred to as a value trap. The reason a company can consistently distribute dividends is because the company is fundamentally healthy. Only if the company can make good profit, they can continuously pay dividends or even increase dividends over the years. A 12% dividend yield is exciting, but it may not be sustainable. One typical example is AT&T. The current dividend yield is at 6.58%. Looks like it is a pretty good return. The payout ratio is at 56.43%, so it doesn't seem very high. In fact, AT&T has made questionable business decisions over the years. In 2022, AT&T spun off Warner Media. So, each AT&T stockholder receives 0.24 shares of Warner Media stock for every share of AT&T they own. Then, AT&T's stock price continuously dropped and the dividend was cut in half in the same year. If you purchase a share of AT&T in 2020 at $28. Today, the stock price is at $17 a share. This is a loss of $11 in 4 years. Meanwhile, your quarterly dividend went from 52 cents in 2020 to 28 cents per share in 2024. As a result, we should avoid companies like AT&T. Now, let's build a monster dividend portfolio with 5 stocks we mentioned earlier: Texas Instruments, Visa, Lockheed Martin, Caterpillar, and Ecolab. These 5 stocks are in 5 different industries, so they are well diversified. If we invest $2,000 in each stock, based on the 10-year dividend growth rate, Texas Instrument at 15.92%, Visa at 18.18%, Lockheed Martin at 19.51%, Caterpillar at 8.20%, and Ecolab at 8.10%, how far can we go? In 10 years, your investment would grow to $39,017. The annual dividend yield is $3,327, so you would receive $277 each month. In 15 years, your portfolio would reach $116,372. Now the annual dividend is $27,985, and it is equivalent to $2,332 each month. Now you can see what a monster dividend portfolio looks like. To recap, they all have reasonable dividend yields, high dividend growth rate year over year, multiple years of dividend increase, and moderate payout ratio. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See you in the next video.